Thank you for tuning in to another episode of Financial Festivities. Join us on this episode when I talk with a former PR grad who now works in the private equity field. All right, welcome back to another episode of Financial Festivities hosted by Prairie. Today, I'm joined by a very special guest. We have Ryan Ruth, who is a former PR grad and now works in the private equity field. So, Ryan, how you doing?
Great. Thanks for having me, Grant.
Of course. So hopping right into it, you went to Prairie High School. How would you describe just your overall high school experience? And did you immediately know you wanted to go into the financial field, or was that something you kind of figured out later in life?
I think Prairie Ridge High School is a great experience. It really set me apart from my peers when I go into college. I think that it's really a great platform for people that want to do business, finance, engineering, a lot of different things because there are so many different programs at Prairie Ridge. I actually spent more time in the engineering program, more so than all the business courses that were offered at Prairie Ridge High School. So I didn't exactly know that I wanted to do finance, but I think it was one of those typical stories that you hear people who start trading stocks out of their dorm room once they go to college and find a new passion. That was very much my story. So I pivoted from sort of the engineering mindset into the financial field.
Gotcha. And then moving on from high school, you went to UW Madison. So aside from your internship experience, which we'll get to in just a little bit, was there any unique experiences like, travel abroad programs or just kind of things that helped expand your worldview and kind of shaped you into the person you are today?
Yeah, I think large schools like Wisconsin have a lot of programs defined in their business school, whether it be student organizations like finance clubs, which are great to be a part of, especially even as a freshman in college. You can join those and start to learn more about the industry or just connect with upperclassmen. So that was one big thing for me, was just exploring, because finance has so many different things. I mean, you could be a financial analyst at a large company, you could be a wealth manager, you could be an investment banker, you could be a hedge fund manager, you could be so many different things. And when you're sitting there as an 18-year-old, you don't exactly know which one is going to suit you best. And then just in terms of global experiences, I studied abroad in Norway. My family was Scandinavian, so I wanted to go back and learn more about the language. And it was a great experience. And so I spent a semester there at a business school. And I would encourage anyone that's thinking about studying abroad, because that was probably one of the most exciting parts of my college experience, and a really big area of growth as well, just learning how to live on your own and explore new places that you've never been before, especially a new territory with a different language, a different just culture itself.
Yeah, that's awesome. Traveling abroad to Norway sounds very an interesting experience. How would you contrast just the Norway culture to here in the States, and just kind of how it helped you, expand your worldview?
Yeah, I'd say, I came into it wide open. I didn't really have a lot of expectations, but it was one of those places where they're very welcoming as a culture, but they are, a little bit different in terms of the school. They don't have tests, they don't have homework. It's
Oh, really?
based on final exams. So I remember every single week, because once I was in Europe, it was really easy to travel to different countries. So each weekend I would choose a different country. So I'd try to go to France, or I'd go to Italy or something. And then all of a sudden, 10 weeks later, I realized that, oh my gosh, we have a final exam coming up. And I don't think I've spent quite as much time as I would have if I was back in Wisconsin. So that was definitely a learning adjustment, was just understanding their academic culture a little bit better. But they're still a phenomenal school system there, and very smart people. So I did learn a lot.
That's awesome. So you had a lot of great internship experiences through UW Madison. We probably don't have time to kind of go into depth about all of them individually, but can you talk about just maybe a few of your internships and what unique experiences and experience in the field you achieved from those things?
Yeah, I think probably, I don't want to spend too much time on them. My sophomore year, I worked at Kimberly Clark. So they make paper products like toilet paper, different things. And that was a really defining moment, because as a sophomore, I didn't have experience working for a large company. It was my first time going to a corporate headquarters and just learning a lot of how to act like a professional, how to work in meetings with people that have been in business settings for 30, 40 years, and a lot of times you don't have that coming out of high school. And so although I didn't want after the end of the internship to pursue a career in corporate finance, I realized that I wanted to be closer to the market, which is why I went to BNP Paribas in New York after that in my junior summer. It was a really defining moment. And so I think getting started early is something that a lot of people don't realize that you could do. There are different programs out there for freshmen and sophomores to get that experience. And so I think it does shape you pretty well. And then BNP, that was obviously quite the market experience. It's an emerging market credit trading and equity derivative structured products. So basically what you see in all the finance movies where there's like 8 screens in front of you and everything's moving and traders are yelling at each other. That was the environment that I was put into. And so that was probably a pretty big defining moment for me in just terms of going into sort of that higher finance field and making sure that that's exactly what I wanted to do longer term. So those internships were very impactful. I did end up taking a return offer with BSP, so I did go there full time, but not on the trade floor or investment banking capacity, but still close to the market as we were pretty focused on debt financing.
Yeah. So with BNP, like what was like your specific job? Like what were you doing like day to day?
Yeah, so day to day, kind of the process of a transaction would be that if you were looking to sell your company, you would hire a bank. The bank would go out and try to sell it, and then people would want to finance that with both debt and equity. And so my particular group would arrange financing. So we would go out and we would create the marketing materials. We would call investors. We would spend a lot of time going through diligence questions and analysis on the company itself or the industry to help potential investors get comfortable, and then come in and write essentially like multi-million-dollar check to help finance that company. So my job as an analyst was very much in the learning phase for the first few months of it, for sure, and getting up to speed. But I think that it was a really good opportunity to get sort of that financial skill set 101, because you had so many reps of, looked at probably over 100 companies that year for potential transactions. So each one was different. So you get to understand the different nuances to how companies make money or what's good about them from an investor perspective.
Yeah. I hear like a lot just about the intense kind of work atmosphere in investment banking and working in public markets. Can you what was like the actual atmosphere like, and what was like the work commitment, like how many hours do you work in a week, that kind of thing?
Yeah, I don't want to sugarcoat the experience. It was certainly brutal. There were plenty of weeks where it was 80, 90 hours or more. Most people were in the office or at least working from home. And I would say that it was one of those jobs where getting off at like 8 or 9 o'clock at night was a good night. It was a lot of times you're going well past midnight to get things done because these are tight time frames, and the bank is always working with clients that you really don't have a choice. So especially at the analyst level. So it's a brutal experience, but it's an invaluable experience because not that many people are afforded the opportunity to be in that role and to be able to dive in like that. So, although it was tough, I do think that it was a great opportunity.
Yeah. Did you have a hard time kind of adjusting to that really heavy workload, or did you kind of have the mindset of like, I have such a great opportunity here, I gotta like stick to it and make sure I'm doing a good job?
I think that one thing that's really interesting, and maybe it's coming from Prairie Ridge or even just my experience in Wisconsin, but I do feel like the Midwest culture is much more aligned with hardworking values and people that they don't always come from living out in the Hamptons and everything. So you kind of look at this world as an opportunity to work harder than your peers to essentially prove yourself in a way. And so I think that it's a little bit of an adjustment, but I do think it's actually coming from a place like Prairie Ridge, you would be perfectly fine because you have great education, very, very smart, and very capable, set you up for a career in finance.
Awesome. So after BNP, you went to Principal Financial Group, and that was more in the kind of the private equity field. How do you contrast that to working in the public markets? And what was like your specific job position there?
Yeah, so I came over to Principal, and essentially what that was, an insurance company takes in a bunch of money when people pay their insurance premiums, and then they don't just sit on a giant load of cash. They go out and invest it. And so I was hired along with a couple of other people. So it was myself and probably 6 people in the middle of COVID, just sitting there on Zoom and basically creating a private fund. And so we were going out investing in private companies. And so my role there was everything from the financial models to the investment memos that we bring to our investment committee, and then just different sorts of fund development exercises as well. So it was a really cool experience because there's so many well-established private market platforms out there. If you think about the largest funds in the world, and we were starting from scratch. We didn't have a single investment. We didn't really even have a committee memo. So I was building everything, and it's a great experience to be very entrepreneurial early in my career. And so it really was the best of both worlds, coming out of banking to get that entrepreneurship experience of starting a fund with pretty low risk, because the insurance company gave us a couple $1 billion to go out and invest it. It wasn't like we had to raise capital necessarily. But then also it was a great experience because it was such a small team that I got to lead a lot of investments and do a lot of the analysis on my own. And so I think when you go to a larger place, the deal teams are just much larger and you don't get that hands-on experience that you would in a smaller place.
Yeah. So was there a huge difference in the pace, just like in terms of, workflow between working like in the public markets at BNP versus what you were doing at Principal?
Yeah, absolutely. I think public market, you get in a little bit earlier. You're looking at how the different markets have moved overnight. You're looking at the news. You're checking on your names. It's very different from just the private markets don't exactly react the same way, and you're very much on a deal timeline. So you're on a timeline if someone wants to acquire a company and the bank is leading a process, and you have whatever 3 weeks to submit your bid to the company. Whereas in the public market, you could buy, sell, do whatever you want, whenever you want. You're really just subject to the market hours to do that. And so I would say private markets are generally, you could say, a little bit longer hours. But I think, especially around earnings season, public markets can be just as brutal from an hours perspective. So in either case, you're going to be working pretty hard because you want to be as deep as you can in all of your investments.
So would you say, like, when you're working in the public markets, do you have to be like more in tune with just current events and things outside the actual company you're looking at? And then with private equity, you're actually kind of just more focused on the individual company you're looking to invest in, and you don't have to worry as much about just what's going on in the news and stuff.
Yeah, absolutely. I would say in the public market, you're always, everyone has a Bloomberg terminal, and as news coming, it comes across the screen, and you're saying, okay, how is this affecting the market? If the Fed's going to do something, or if there's some geopolitical event that happens, the market reacts in so many different ways. And so all of that is immediate. And so you get to see that happen in real life as things trade up or down. In the private market, though, there are times where you're so deep into your deal, which could be a very specific company that does a very specific product. It could be a very niche industrial company. Like, let's just say if they make those valves that go on some sort of pipe in a factory. You might be researching everything about that valve and everything that you need to know about that industry, and then you have no idea what's going on in the world unless you read the Wall Street Journal or open up Bloomberg. So it's kind of funny in that way, where you could end up just watching as news goes past, and you're just only invested in your specific transaction on the private equity side. So there's pluses and minuses to both, but I definitely thought that it was really exciting to be in the public market and watch everything move so quickly.
Yeah. Would you say the private markets might be a little more attractive for a career for someone who really likes just like looking at companies and just get like evaluating them and who like might not necessarily be interested, and kind of just like looking at the news cycles over and over again, and kind of just being able to focus on the companies themselves, because I'm sure it can get exhausting just like looking for current events just all the time and seeing how that affects the markets.
Yeah, I think so. I mean, I think public markets in a way are kind of converging to indexes anyways, and so it's very hard to be an
Yeah.
active fund today. And then when you think about what banks do, primarily on the public side, is they are what's called a market maker. So they're just matching buyers and sellers. And
Yeah.
so they're not exactly taking balance sheet risk. They are in a way. There are certain desks that do, but a lot of times I don't think that sort of the old school, I'm going to buy, 1,000 shares of Apple. It's just they don't really do that as much anymore, because so many people have moved over to passive funds.
Mhm.
But that's not to say that you can't make money in public markets. I think it's a great career for a lot of people, and there's a lot that can be done there, especially for those that really like the current events, really like keeping up with publicly traded companies.
Yeah. So now you work at Aries Management. Can you kind of just describe like what that is and also kind of what you do just as a job right now?
Yeah, so Aries Management, they're probably one of the largest alternative managers in the US. So probably 280, almost 300 billion AUM now, split between, we have private credit, which is really the bread and butter of Aries, and that's what I work in. We also have private equity, real estate, and infrastructure, all private markets. So on the credit side specifically, what I what I do is, you think about exactly how it works is, if you are a set of investors going out to buy a company, it's similar to buying a house, and you typically don't buy a house with all cash. Some people do, and that's fine. But from a returns perspective, you want to put leverage on the company, and so that's like writing a mortgage to the company, sort of like writing a mortgage to the house. And so traditionally, back 20 plus years ago, banks used to only write these loans to companies. And after Dodd-Frank, different things, that's not exactly the case anymore. And that's where the emergence of private credit funds came. And so essentially, it's similar to a private equity fund in terms of they have different investors that invest in the fund. But we go out, instead of buying the equity of the company, we write a loan to the company, and that's how we generate our return. Obviously, if things go poorly, then they default on their mortgage, kind of like a house, then we own the company. That's not really the goal. The goal is to have performing companies, but that does happen every now and then. So that's what I work in. So we do a lot of the same analysis as private equity. We're on the same timeline. We work alongside private equity firms. Not typically our own private equity funds, but other private equity funds, and we come in from a credit perspective, and we write those loans out to the company, so that other private equity funds can generate their return and we can generate ours. So hopefully that makes a little bit of sense. I try to condense it down.
Yeah. So like for private equity, that's where people are actually going out and acquiring businesses. But for the private credit, you're also looking at businesses, but you're like looking to loan to them and not actually kind of acquire them. That's the difference between the two.
That's right. Yeah.
Yeah. So what's the process like? Like what specific companies do you like look at to loan to? Like, is there a specific like market cap or like a specific, sector of companies you guys usually look to loan to?
Yeah, I'd say typically it's what's called the middle market, is where a lot of private debt has been. So if you think about companies that generate, call it $10 to $50 million of what's called earnings.
Mhm.
So not massive companies, but they can be really good companies for really good private equity firms. But Ares is one of the largest private credit platforms in the country, and so we have the ability to do multi-billion-dollar transactions. And if you look at even just like public markets over the last 20 years, the number of publicly traded companies has declined, and the number of very large private companies has increased. So there's more of a need for private funding, and so that's where we step in, because historically you go to a bank and you have to get like 100 different lenders.
Gotcha. So, and then in terms of the private equity side, I know that's like not your specific field, but I know Ares uses what you guys call like a leverage buyout a lot, and so does a lot of other private equity firms. Can you kind of describe just like the concept of the leverage buyout and why it's advantageous to just simply using just pure equity?
Yeah. So leverage buyouts, that is really the bread and butter for credit as well. So do spend a lot of time there, so I can speak to that. So if you think about it, why you wouldn't want to pay all cash for a company is because you only have a limited amount of dollars for private equity fund when you raise a new fund. So if you raise a $100 million fund, if you spend all $100 million buying one company, you're not going to be really well diversified, and you're also spending all that money and putting all of your eggs into one company, whereas you'd like to spend maybe $20 million and then finance it with $80 million debt, which would be a little aggressive, but let's just say for that example. And then if you were to sell that company in the future, you're hoping to sell it for more than what you paid for it, and you're also getting the cash flows from each year from operating business. And so the debt investor, they really have limited upside because they're just clipping their coupon away. So when you pay your mortgage from your house, you're paying an interest rate. That's all that you give to the lenders. But everything else the company earns goes right to the private equity fund, which is great because if they didn't spend as much money at time zero, and then they could sell it for a lot more and pay off the debt, they get all that incremental dollars. So leverage is primary way to increase your return. And so that's why leverage buyout is so popular. It obviously started quite a few years ago. I think KKR was one of the giants that really invented it. There's you could read about there's a number of high yield bonds that they used to do back from the 80s. But now it's these mega loans that private credit funds provide. And so it's a really interesting space. It's a really growing space. They're projecting could be well over $1 trillion.
Oh, wow.
Yeah, so by 2025, it should be well over $1 trillion in private debt. So I think it's a really cool space to be if you are interested in a career path that you want to be very close to private equity, but you're not sure that you want to operate a company, but you want to see as many companies as possible through the leverage buyout lens. And that's really what credit provides.
Gotcha. So you use a lot of debt when you're acquiring the companies, but like for the little equity that you do use, do you like get that money from like investors? I think I read they're like called limited partners, and like, do you guys have any obligations to like give them some of your earnings or something like that?
Yeah. So limited partners, there's a number of different ways to raise a fund. The limited partner is probably the most prevalent. And that's basically, it could be a large like sovereign wealth fund. It could like be a pension fund, like Illinois Teachers, for example, could be an LP in a private equity fund. So it's very large investors that can write, $100, $200 million to a private equity fund, and then they get like 4 or 5 of these people, and then they raise like $1 billion fund, and then they go out and then they invest that fund, and they have $1 billion worth of equity in various companies that they're operating. So they call the capital from those LPs as they're making the investment, and then their obligation is to pass along the returns to those LPs. And then the way that private equity funds make money is a management fee, which is not that much, like maybe 2% of the fund. And then they also make a performance fee. So they say, okay, if we return 20% to our LPs, anything above that, we get to keep ourselves, for example.
That's like that 2 to 20 rule thing. Is that kind of like an industry norm?
Yeah, I mean, those always move depending on the fund, but that's kind of an industry norm for sure.
Got you. So would you say the majority of like the money that private equity firms make are like from those management and performance fees from the limited partners, or actually from the success of the companies they like acquire and then eventually selling those companies for a profit?
Yeah, I'd say the large majority of how private equity funds make their money is from the investments themselves
Yeah,
performing well. And there's a thing called carried interest. And, that's typically how a lot of the most senior people at private equity funds make their money. But yeah, the management fee is kind of what keeps the lights on, what pays the bills and
yeah,
everything like that. It's not really a huge moneymaker. But the investment performance itself is what's critical to being a successful private equity fund. Because also, if you have a lot of companies that go bankrupt or something like that, it's very hard to keep your investors or raise new funds. And so raising larger funds is not possible when you're not performing well.
gotcha. And so back to the debt side of just financing these acquisitions, what would you say the ratio is normally in a leverage buyout of debt to equity? And where are you guys actually like getting your loans from when you're acquiring these companies?
Yeah, so it's hard to say there's a typical mix because it's very dependent on the industry
Okay,
and the company itself. So something like tech, right? Tech is very popular. People pay a lot of money for tech. People could be paying 15, 20 times earnings, which is a pretty substantial amount of money from just a valuation perspective. And so you can really push leverage sometimes on those companies, especially if they're nice companies with recurring revenue and have a good business model. But then you look at something that could be highly cyclical, like an auto part manufacturer. Like you're probably not going to be very happy if you put 80% leverage on a company like that, because if their earnings decline even just slightly, they could be in a very, very bad situation. So it's very credit specific, but a lot of times people try to get close to like a 50-50 mix.
okay. And then again, when you guys are actually using debt, where are you borrowing it from?
So the private equity funds borrow it typically from the private credit funds. The credit funds themselves are similar to the private equity funds. They have their own investors that go out and then we write essentially the loan to the private equity company itself. The company holds the debt and then the private equity fund manages the company. So that's kind of the flow of how that works.
Gotcha. Cool. So do you just kind of have like any just other comments about your job or just nuances that you kind of enjoy, just or things that are typical or different from the public markets?
Yeah, I mean, I would say one thing that a lot of people don't realize is that in the public markets, when you're dealing with very large companies, it can be harder to access management or diligence the same way that you would in a private market. So in a private market, these companies could be, a medium-sized company that's owned by a family, or it's a lot easier to call, and I had the opportunity as someone who's been out of college for just a couple of years to
Yeah.
call the CEO of the company and ask him any questions he wants about the business, or call the CFO, or fly out and actually tour their manufacturing facility or something like that. So it's very hands-on in private markets because when you're buying the entire company, there's a lot of risk in that. And when you're buying, shares of a company in a public market, there's a lot of things to do from that perspective. But I think that it's just different when you're actually operating it in a private equity space. But I think everyone will probably have their preferences as to what they enjoy a little bit more. And that's the important thing about taking time to really get those experiences early on in college, or even as a high school student, very rich, just call on people and ask a little bit more about what they do if you're kind of interested in a field and you're just unfamiliar with the terms or different perspective career paths.
So when you're like looking to acquire a company and you're doing like all the research, talking to their CEO, going looking at their factories, how long does like the actual process take? Like, are you looking at like one company for like months? Are you like really actually kind of getting like into just like, the nuts and bolts of how a company works? Like, how long does the process of acquiring a company actually take, or does it depend?
Yeah, it can take months for sure. I mean, I've seen things take almost a done, start to finish. Private markets, they have a lot of process around it versus public markets that have, more trading, putting it in order, and that is kind of the way that you can execute it. But here, it's much more cumbersome in terms of working with an investment bank on the company, diligencing the company, working with lawyers, working with accountants. There's a lot of involvement that you could be working on a particular transaction for several months. And then once you own the company, unlike a bank or other places, you can't just like move on to the next thing. Like once you own it, like you're sitting here, you're actually having to operate the company with the management team, and then look at potential add-on acquisitions for that company. If you're going to merge them with someone else and make them larger. So there's a lot that goes into how exactly your day can be split working in private equity, but definitely deals take a pretty significant amount of time, especially for a fresh leverage buyout.
So how do these companies like make it apparent that they're willing to be acquired, or how do you guys how are you able to know which companies are out there that you have the possibility to, buy out?
Yeah, there's several different ways. I think the most popular way is the company itself. Let's say the family owns it, the owner passes away, the kids don't want it, they put in a trust, and then they hire an investment bank to go sell the company. And then that investment bank creates like an 80-page presentation on everything you want to know about the company, and they call up a ton of private equity firms, and then all these private equity firms start bidding for the company in sort of a competition. So that's like one of the most popular ways. But also, there's private equity funds that maybe they own a company and they want to buy the competitor. Competitor might not be for sale, but they know the CEO, so they call him and they say, hey, let's grab dinner or whatever. Let's talk about your business. And then they try to see if there's a price that owner would be willing to sell the company for. So that's another way. If you're doing a public to private, you could buy up all the shares of a public company and take it private. That's a little bit more nuanced, but there's plenty of ways to find companies. But I think one of the more traditional ways is going through an M&A process with an investment bank.
So you would say like there's never like a lack of companies that are out there that are willing to be acquired. There's always kind of a lot out there that people are bidding for and stuff like that.
Generally, yeah, there's quite a bit out there.
Okay.
The market will ebb and flow for sure. I mean, there will be different times of the year where I think it's a little bit hotter, and they do generally kind of move with public markets in a way. Like in public markets, they're tanking. Private market valuations are also going to be tanking. And so if you're a private company, you probably don't want to sell your company when the whole market's down. So you might wait a few months or a couple quarters and say, hey, let's see if this recovers. I want to see if I can get a little bit more for my company. And so maybe the actual deals in market will be a little bit less during that time. But yeah, I mean, there's so many different companies out there, so many different industries. It's definitely a massive. I mean, private equity itself is probably a multi-trillion-dollar industry, much larger than private credit.
Yeah. So one last question just about Aries itself. I know it's probably like not directly down your avenue of like actually once the companies are acquired, you guys don't you kind of play a little bit of an active role in terms of managing the company. Like what steps do people at Aries take to like once the companies are acquired, kind of try to, increase revenue and eventually be able to sell it for profit and make the company more valuable? Like, are they like taking like positions on the board of directors and things, or like what kind of decisions are they making for the companies once they're acquired?
Yeah, so most private equity funds will have a board seat, or at least more than one. They will also, at certain times, bring in their own management team. So they may want a more professional management team if it's a company that was historically not run at sort of an institutional level. So they might bring in a new CEO, a new CFO. In terms of growing top line, they're going to work with consultants. They're going to have their own internal people, advisors that are going to help review the products, review the revenue model, the marketing, everything, and make sure that there's really an optimal products that they're offering or their sort of value proposition. And I think one of the ways that private equity grows companies fastest is through M&A. So just acquiring more similar companies and merging them together. So the typical roll-up or add-on strategy is very popular. So there's a number of different levers that private equity funds have, but it's very operational. There's a wide variety. So if you're acquiring a very, very small company, sometimes they don't have formal financial systems. Sometimes their management team has never done sort of like a Salesforce strategy or anything like that. So you're bringing in more tech solutions to help bring the business to the next level. And so that can be time consuming, but it can unlock a lot of value. So private equity funds are really good about really transforming kind of sleepy businesses or businesses that have been historically mismanaged and helping them to grow and deliver more to their customers and then deliver more to shareholders. Private equity sometimes gets a bad reputation because you hear of different private equity funds historically that have bought companies, like laid off everyone and stripped apart different plants. That certainly does happen. There are times where it makes sense to sort of trim the fat because it's just, if you actually dig in and look at it, it doesn't make economic sense to have different people or different plants open. But generally, the goal is to create shareholder value. And a lot of times, you think about it, when they're buying companies, sometimes the family leaves money in the company or the management team leaves money in the company. So that inherently is beneficial to those that are running the company. And then if you also think about who's actually investing in these private equity funds, it's pension funds like teachers, firefighters, those sorts of people. And if you're generating returns to them, that's their retirement. So, it is in all, they are trying to really maximize the shareholder value. And so I think a lot of times it can be misconstrued with a couple of funds that have been more aggressive in the way that they do it. But generally speaking, everyone is trying to create the most profitable, best company and really maximize the return. So.
Cool. And just from an investor standpoint, like from my point of view, like are there like funds that are publicly traded that track like the holdings of private equity funds? Like could I like take a holding like indirectly of like the a private equity firm like this Ares do something like that or no?
Yeah, I mean, Ares is publicly traded. Blackstone's publicly traded. I think KKR, Carlyle. There's all the top private equity funds have some sort of publicly traded security now. They used to be private, but a lot of them are IPOs. So you can get that exposure for sure. It's definitely not quite the same as being an LP. But if you want to generally get exposure to private equity, and then if you want to get exposure to private credit, there are easier ways to do it. There's something called a business development company or a BDC, which is essentially just a private credit fund that trades on a market, kind of like a real estate trust. And so Ares has one called Ares ARCC is the ticker. But those BDCs you're pretty much directly investing in the funds they use to write loans to companies that are owned by private equity firms. So it's actually a pretty interesting place. They have very high dividends because they operate kind of like a real estate trust. Historically, they've performed pretty well. So it's a nice place to be if you're just looking to kind of diversify away from equity, get some more unique exposure.
Yeah. So if I were just to buy like, shares in Ares, would that just be kind of tracking the just performance of the overall company? Because like you said, there's different, sections of Ares, like they do credit, they do private equity, they do real estate. So it wouldn't just be like the private equity part, it just kind of be the overall business model of Ares tracking it.
Yeah, that's right.
Okay.
Yeah. But if you did Ares Capital Corporation, ARCC, that would be directly investing in the private credit arm, which is the group that is writing the loans if you want to just get credit exposure.
Okay. And then moving on from just, your job specifically, like where do you see yourself in the next, 5 or so years? Are you happy with private equity? Are you looking to, do you have any other aspirations for your career? Are you happy with where you are? Yeah,
I'm pretty thrilled with where I'm at. I think that it's it's definitely still a very exciting place to be. I really like private markets. I've been pretty intentional in different career pivots that I've made, and I think just getting a deeper expertise in a couple of sectors and a couple of fund vehicles will be pretty critical over the next couple of years with Prairie. So that's one exciting part is that we do have sector coverage, and then I'll be working, making different investment recommendations on the funds that I'll manage. So typical buy, sell, and then new investment recommendations with our investment committee. So spearheading those sort of lead capacity is exciting. But I guess in the next 5 to 10 years, I really have to kind of play that out. I do have some friends here in the city that talked about creating our own fund at some point. So I think that could be pretty exciting one day to do something, either private credit or private equity, with people that I trust and people that have similar experience that we could potentially offer. But I definitely think Prairie is a great platform. I could grow a company for a number of years and still get a lot out of the experience. Every day is new, every deal is a different deal. So it's not like it's a mundane sort of role because everything is moving not as quick as public, but it is moving pretty quickly. And you're adjusting to many different companies, many different types of analysis, and all that's great.
Cool. So, well, if you ever, go through and make your own firm with some of your friends, wish you the best luck. That definitely sounds like a lot of fun. That's something I would most want to do down the road. So moving more of like down the advice route, you're in a position where you've gone through high school, you've gone through college, you have a pretty, I'd say sweet job right now. Do you have any advice for, people my age who are interested in business and finance and going down that route? Just kind of any specific recommendations for decisions to make while in college, internships, things like that.
Yeah, I mean, I think if you are interested, get involved early. The recruitment cycles for banks and everything else is hyper accelerated. You basically need to make the decision if you want to do investment banking or one of the buy side type of roles, really almost your freshman year because it's effective recruitment pipeline. So I would say start early. As soon as you get to campus, if it's something, even if you're just remotely interested, at least attend a couple of the student organizations because that's where a lot of banks recruit directly out of select what they call target schools, and then those target schools have different organizations within them that have certain clubs, and a lot of them are selected clubs. So in order to get in those clubs, you have good grades. So a lot of times it's very exciting to go to college, but if you don't have a near 4.0 your first semester, it could be pretty tough sometimes to get into these programs.
Okay.
Or keywords. And then outside of that, I think just networking, making sure that you have a genuine interest and that you're keeping up with the news, you're keeping up with certain companies or industries you like. All those things are going to help you to interview for the student org, interview for that next internship, and then really shape exactly what you want to do. So I think the other thing is just keep your options open. At least I did that because some people come in freshman year and they say, oh, I have to be an M&A banker at call it JP Morgan. If I don't get that, then I'm done. And if they don't get that, a lot of times they don't know how to deal with sort of that, I don't want to call it failure, but I guess inability to meet that goal. And they're too far gone in the process that they didn't leave any other options. And so I think that it's really good to explore a little bit, especially early in your college career, and see, maybe there is something else out there that, although it wasn't exactly what you thought it was going to be, it may give you a unique experience, and then you never know the next year if you're going to recruit for potentially your dream job and how something else could be relevant. So I think a lot of people just really come in eyes wide open. I mean, even like what I'm doing in private credit, they never even talked about that in college. Like, I had no idea what it was. And it's a really great field. It's a growing field. A lot of people leave banking to go into private credit, similar to private equity, and nobody really talked about it. And so just getting that exposure, connecting with the long, it's all great.
So you say keep your options open because I'm sure, when you were in college, you didn't know like this was a specific job you'd end up being. I'm sure you're very kind of happy with where you are right now. So just keep your options open. All right.
Yeah.
And then the last question, this is kind of like a financial, podcast. I do talk about, how people can deal with, investing and stuff. So for someone like my age, what would you recommend just thinking about down the road saving for, retirement and for a future family? Like you think putting money like in 4 or IRAs, it's too soon for someone like me, or like, how do you think someone my age should get started with investing right now?
Yeah, I would say maybe I group it a little bit differently. So someone your age, I would encourage you to open up a brokerage account
Okay.
and take whatever risks you want and whatever you're comfortable with, and just give the market a try, because a lot of times people don't really know if they want to do finance. They kind of like it, but they've never even done a trade themselves until they go and get that internship their junior year or senior year. And then they realize like, oh, maybe this isn't exactly what I want to do. So when you're 18, I think you can open up a brokerage account. I mean, you put a little bit of money in there and you just get that experience of, you research a company that you like and you kind of have some sort of thesis around it and some sort of price target in mind based on whatever analysis that you might be doing. It's kind of fun because that's where you really kind of prove out how markets work, how the news reacts, and how different trading strategies you might want to go into. And so I would say when you're young, you might as well take advantage of that. And, it also helps you just to think about business in general, what businesses you like, what you would invest in, what the risks you see in businesses. And those are all great talking points and good things that as you're in class, you can also think about and reflect on as you look at your own portfolio. But then in terms of maybe a couple of years out, maybe your first job out of college, I would certainly say max out your 401k. That's a great opportunity. Most employers offer some pretty competitive matching programs, which is, I mean, essentially free money. If you just put in whatever it is, call it like 8% of your salary, they'll match 8% of your salary. I mean, those are all dollars that you put in the market from your employer helping you with your retirement. So definitely take advantage of that. Start early. If you think about the way that retirement works, the compounding effect of returns is important. That's driven by time. And so if you put time on the exponent, starting early makes a big difference. So even if it's not that much money or you don't think it's that much money, it's actually pretty important to start sooner rather than later. And then I would say, there's a number of other ways as you get older to try to diversify your portfolio or do different things. I've been a big fan of just index funds, low cost, passive funds. I think Fidelity even has a zero cost fund out there now. There's a number of them. Those are great ways if you just want equity exposure, but you're not taking a particular view. Those are also great for your 401k, so you can put those in there. And then a lot of people like myself have a personal trading account on the side. So you have your more formal retirement account that you're putting that money away, but then you can take particular views in different markets, or you can do options or different things. And so keeping that on the side is also very exciting in a way to generate some income on the side, or just really stay in tune with the market. So those are all great things to do. And it doesn't take much to get started early.
Yeah, I can attest to that. I have a brokerage account with TD Ameritrade. It's not too much money. Obviously, I don't want to put my life savings in there, but it's fun to just kind of play around with it, invest in a company you believe in. And then you'd say, wait till you get your first job to kind of, put your money away in those 401ks and IRAs, because, once it's in there, you can't take them out without, paying a pretty big fee. So, all right, cool. I think that's going to be it for the podcast. Ryan, I appreciate you very much for taking the time out of your day to join us. I think we had a very great conversation. So yeah, thank you very much. This is Financial Festivities signing off.
Thanks, Grant.
Look forward to my next episode when I talk about current inflation concerns in the US and the history of inflation and deflation throughout the country's history.